Please come to the next question. This time this instrument is issued at a discount. But don't pass entry for discount. Those who are in school days. On 1st January 2015, entity A issued a 8% debenture in the market for rupees 93,400. Okay. The debenture has a principal amount of rupees 1 lakh that will be repaid on 31st December 2019. The quoted market interest rate is 7.64%. Prepare debenture account. Assume amortized cost category. Under this standard, you have to pass the entry. So you will first pass the entry. Write the format first in the notebook. In the books of entity A, issuing company, debenture account. Little fast, be active. In 30 seconds we have to finish it. 1st January 15. By bank. How much you have written? 93. And then 31st December 2015. By interest using effective interest rate 93,400 into 7.64%. 7136. Then 31st December 2015 to bank coupon payment. How much is coupon payment? 6% of 1 lakh. Is it 6,000? To balance carried down, date write down 31st December 2015. Anybody balance 94,536. This is called effective interest rate method. You are accounting interest on the basis of opening balance and effective rate. So you are charging more if your opening balance is more, if you are charging less if your opening balance is less. Okay. So by balance brought down 94,536. 31st December by interest. Anybody who got the answer? 7,223. Is it right? And then 31st December 2016. To bank every time write down 6,000. To balance carried down. Come on. 9,7,5,8 or 9 is welcome. 1117. By balance brought down 95,758. 31st December 2017. By interest 7316. 31st December 17. To bank 6,000. To balance carried down 97074 is right. Are you checking or copying? Both. That is right. By balance brought down, at least do one of the two. By interest on opening balance at 7.64%. 7416. Then 31st December 18 to bank. Yes, come on. 6,000 and 2 balance carried down 9849 1 or 0, both are okay. 19 by balance brought down quickly 98491 by interest balancing figure. Wait, first come to debit side 31st December 19. To bank total payment made 6,000 rupees for coupon, 1 lakh rupees towards principal. So 1 lakh 6,000. So here you take interest as a balancing figure. How much? 7509. Tallied. So how many seconds we took? More than 30. No problem. One more question which we had solved earlier in the books of investor. Now we'll solve it again in the books of the issuing company with some more complications. This question we had done in the books of investor earlier. B Limited gave advance to C Limited. Search for this question. 4 rupees 10 lakh on 1418 at interest rate of 10%. B Limited received rupees 15,000 as processing fees. B Limited gave at 31st March 19 loyalty bonus rupees 5,000, and as per contract B Limited is to receive 10,000 rupees on 31st March 2021 for re-verification of credit fees. Loan is to be repaid by C Limited on 31st March 2022. Prepare loan account in the books of C Limited. Who is the entity C Limited? Borrower. So for C Limited, now this is a liability. Is it right? And they will follow amortized cost category. In the previous two questions, you were given effective interest rate. In this question, you have to calculate, but then the same problem I have done earlier also. Can you trace that question? 17. Okay. So what was the IRR in that question number 17? 10.61? No, let me get it verified from more sources. This question which we solved earlier, 10.625. Is it right? 10.625. Dear student, we have solved this question number 17. Same problem in the books of B Limited we have solved. So calculation of IRR, write homework. Copy from there. And then you write down the ledger account. So step 1, write down calculate IRR in the notebook. Step 1, calculate IRR 10.625%. Refer question number 17. Okay. In the exam, don't write, refer question number 17. There are only 6 questions. Or 4 or 5 questions, for example. But so keeping that question number 17 in front of you, we will solve. In the books of, write down C Limited. In the books of C Limited, in the notebook, write neatly. You have to read it also one day. In the books of C Limited, loan from B Limited account. Loan from B Limited account. How many years are involved? 4 or 5? 4 years are involved. 18, 19, 19, 20, 20, 21, 21, 22. So first entry will be B Limited gave a advance to C Limited for rupees 10 lakh. Entry for this transaction. Bank account debit to loan from B Limited account. Date, write down 1st January, 1st April 18 by bank. These are basic problems you should be able to solve. Now it says B Limited received rupees 15,000 as processing charges. B Limited received means who paid? C paid, loan account debit to bank. Same date 1/4/18 to bank. All transaction costs will be adjusted in the carrying amount only. If it is an amortized cost instrument, the transaction cost or associated cash flows on day one adjust in the carrying amount only, and it will get adjusted in effective interest rate. So 15,000 effect is gone. Where? In effective interest rate calculation. Now it means my net balance on day one is 9,85,000. Is there any other transaction on this date? It says B Limited gave at 31st March 19 loyalty bonus of 5,000. But first I'll pass the entry for interest 31st March 19. By interest. By interest, your effective rate you said 10.625% of 9,85,000. 1,04,000. Check in that answer 70 number, is it same? You can keep that answer also, and it is easy for you to pass the entry. Everything is appearing on the opposite side now. And one more entry we had passed on 31st March 19. B Limited gave loyalty bonus at rupees 5,000. We are in the books of C Limited right now. So they will receive bank account debit to loan. So write down same date. By bank. How much is that amount? Is it 5,000? 5,000. Is there any payment made by C Limited to B Limited on 31st March 19? They must have paid some interest on that day. How much interest they have paid? 10 lakh into 10%. So to bank. Keep that question number 17 also if you have the answer, to check whether your answer for first year 2 balance carried down 99465 994. Is it there in that 17 number also? Check. There. Okay. That's good. Now we'll come to 1419. By balance brought down. By balance brought down 994,656. Then 31st March 20. By interest 105682, and 31st March 2020 to bank. How much? Is it 1 lakh? Do we have any other transaction in this year? No. When was that credit re-verification fees? Next year. Okay, next year. So 2 balance carried down. 2 balance carried down. Come on. 10 lakh 00338. Is it right? 1000338. Then write 1/4/2020. By bal brought down 1000338. By interest. Anyone in by interest? 106,286. Come to 31st March 2021. To bank, 2 items I will write. First I will write interest 1 lakh. Who paid credit verification to whom? B Limited received 10,000. So it means C Limited paid loan to bank. In bracket credit re-verification fees. Is it 10,000? And two balance carried down. 99, 66, 24, 1421. Why? Balance brought down. 996624 and 31st March 2022 to bank. First I'll pay. How much I will pay? 11 lakh. 1 lakh plus 10 lakh. 1 lakh plus 10 lakh. And so write by interest balancing figure amount 1033. Is it tallying 11 lakh? Is it just the opposite of that 17 number question? So be careful in the exam. In whose book they are asking you, accordingly solve. They can ask you ledger account. They can ask you journal entries. Okay. So these are the three questions on financial liabilities measured at amortized cost. Very easy. And even easier part is financial liabilities measured at FVTPL. FVTPL means fair value through P&L account. Change in fair value will be recognized in P&L account. First, those financial liabilities which are held for trading will always be classified as FVTPL. Okay. And those financial liabilities which are designated by the management as FVTPL, then those will also be classified as FVTPL. Even though it may meet the definition of amortized cost category, but management on its own voluntarily can choose FVTPL category, but this designation is irrevocable. Normally, when would they choose a debt instrument in FVTPL category which should have otherwise gone into amortized cost category? To ensure that there is no accounting mismatch, to ensure there is accounting consistency, there is no accounting mismatch. A simple example which I will give right now. Suppose you are a company, you take loan and you give loan. You take loan, give loan. This loan is your financial asset, this loan is your financial liability. Okay. For some reason, suppose this loan is classified as FVTPL. This loan is classified as FVTPL. Let us say it does not fit into the amortized cost or FVT OCI category. So what will happen? The asset will be measured at FVTPL. Change in fair value will be recognized in P&L account. And this loan, suppose you show at amortized cost. Now, why the value of this loan normally changes? Due to change in market interest rate. If the market interest rate changes, fixed rate debt instrument value change in opposite direction. For example, if the interest rate goes up, the value of your debt instrument will fall. Is it right? So same thing here also. So what will happen? If you follow FVTPL for this asset only and follow amortized cost for this instrument, then you will have to book the loss for the loan asset. But no such loss will be booked for liability. But if you value this also at FVTPL, so value of your asset will decrease, value of your liability will also decrease if the rate of interest goes up. Yes or no? Value of your asset and liability both will decrease if the rate of interest goes up. Higher the discount rate, lower the present value. But decrease in liability is a gain. Decrease in liability is a gain. And decrease in asset is a loss. So then the loss and gain both will go to P&L account. And therefore, you will not have a very high loss or high gain in P&L account. So P&L account will not become too volatile in that case. Is it right? Another example, this was simple. So generally they will try to ensure that the asset that is financed by a liability, they will try that both of them are carried using the same measurement principle. Or let us say you have a financial liability, a debt, debenture or a bond. Now there is a risk involved, which I am going to again discuss in the hedging part. There is a risk involved. If the market rate of interest falls, the value of your liability will go up. Yes or no? Or if it is a floating rate instrument, if the market rate of interest goes up, you have to pay more interest. So to protect yourself, what you can do, you can use a derivative. The derivative usually used for hedging such risk is interest rate swap, which I am going to discuss later. That means you can use interest rate swap. What interest rate swap does, it converts your fixed rate obligation into floating rate obligation or floating rate obligation into fixed rate obligation. Now, if you have taken a derivative, you have learnt in last 2-3 days derivatives will be accounted as fair value through profit and loss account. And same problem here, if you are measuring this as amortized cost, this gain or this loss will go to P&L account and this gain or loss will be ignored. So P&L account will become volatile. So what if I account this financial instrument also as fair value through P&L account? So loss in this will be gain on the instrument, or the gain on the instrument will be loss on the underlying hedging item. So then the loss and gain would nullify each other to a large extent, set off, and you have minimum impact in the profit and loss account. So that in that case, what the management can do, they can designate this financial liability as FVTPL. Okay. Again, some more discussion on FVTPL. When will a financial liability held for trading fall under this category? It is acquired primarily, principally for the purpose of repurchasing them in the near term. Now here the institute is saying, the standard is saying, if you have suppose issued a debt, debenture or a bond, but your objective is to buy back the bond in the near term. Today you need money, you issued, but I want to buy back after 3 months. So in that case, this instrument will be designated as FVTPL because my objective is to repurchase it, buy back this instrument in the near term. Second, it is a part of a portfolio, and that portfolio is used for short-term profit booking. This financial liability is a part of a portfolio, and the portfolio is used for short-term profit booking. The whole portfolio is managed for short-term profit booking. Then it will be designated as FVTPL. Derivative liabilities, usually FVTPL only if it is used for hedging purpose and the management designates it as a hedging instrument for hedge accounting purpose, then follow the special rule of hedge accounting. So what are the example of liabilities which can go into FVTPL category? Interest rate swap, in fact all derivative, Derivative liabilities incurred upon writing a foreign exchange option that is not accounted as a hedging instrument. This line will come again and again. For every derivative, one additional sentence comes which is not used for hedging purpose in hedge accounting. And then an obligation to deliver financial asset borrowed by a short seller. What is the meaning of short seller? Short seller means an entity that sells financial asset that it has borrowed and does not yet own. So this is a financial liability, because then you have an obligation to deliver the underlying asset. Okay. So short sellers, what they do? They expect price will fall. They bet on the downward movement of price. They want to make profit from this situation, but they don't have the underlying asset. So they borrow from somebody today and they sell in the market. So what is their obligation now? They have an obligation to buy later and return the underlying asset to the party from whom they had borrowed that underlying asset. This you have learnt in strategic financial management subject, if you have read that subject. Yes or no? So what is his obligation? To deliver the financial asset. Then a quoted debt instrument which the issuing company wants to buy back in the near term. Some repetitions are there. Designation of financial liabilities as at FVTPL. This standard gives management the power that you can designate any financial liability as at FVTPL, but once you choose this option, then you cannot subsequently change the classification. So normally you should use this option only to avoid any accounting mismatch, which I explained to you, and one example also is there in your book. To understand the concept of accounting mismatch, entity A issues fixed rate date. Okay, so you have issued a fixed rate debt, means liability. In order to economically hedge the fair value risk associated with interest payment on the fixed rate debt, entity A concurrently enters into an interest rate swap. Interest rate swap is a derivative which effectively converts your fixed rate into floating rate or floating rate into fixed rate. So on one hand you have a fixed rate debt instrument which is your normal financial liability, and on the other hand you have entered into an interest rate swap. If I do accounting independently, then this instrument will be accounted at amortized cost. Interest rate swap will be accounted as derivative. Change in derivative value will go to P&L account. The interest rate swap is derivative and must be measured at FVTPL. Now what I will do, I will choose to designate this fixed rate debt instrument as FVTPL, even though I should have used which category? Amortized cost category. The reason is that this diagram clarifies that change in fair value of derivative will go to P&L account, and in the same year the change in fair value of the fixed rate debt will also go to P&L account. So both will hit the P&L account in the same year. And what will happen if there is a loss in this? There will be a gain on derivative, and vice versa, so that you have a minimum impact in the profit and loss account. So this is the reason why a management can choose to designate a debt instrument in FVTPL category. Okay, and see the answer is also written for you, don't write. By designating the fixed rate debt as at FVTPL on initial recognition, the entity will achieve a substantial offset in the profit or loss against the fair value movement on the held for trading derivative. Substantial offset means almost negligible impact in the P&L account, because the instruments share a common risk. What is the common risk to both? interest rate risk. If interest rate goes up, value of liability falls and vice versa. And similarly, if the interest rate changes, the value of your IRS, interest rate swap, also changes. Entity A will seek to demonstrate that applying the fair value option results in more relevant information because it significantly reduces a measurement inconsistency that would otherwise arise from measuring the derivative at FVTPL and measuring the data at amortized cost. Can you write like this? You have to practice. Student will write yes, no, maybe. Now, none of the above. Writing the answer is also a skill for theory question. Now we'll come to business combination. Simple. Apply Ind AS 103. Now in business combination, there are two parties. Acquirer, acquiree. The one who acquires the business of the other entity is acquirer. Now what they are trying to say, I'll just simplify it right now, not very important. Do you need to use the same classification at which it is appearing in the books of acquiree? No. What the acquirer will do, it may either use the same classification or it may change the classification. So they might be showing it at FVTPL, but I may show it as amortized cost or vice versa. Okay, for example, the acquirer in the CFS may choose to designate a financial liability at FVTPL at initial recognition, even though the acquiree may have classified it otherwise when it first recognized the liability. You can do this. More discussion in 10 in IFRS 3. Now, dear student, come to subsequent measurement. Already done 3 problems. If it is amortized cost instrument, use effective interest rate method. If it is an FVTPL instrument, measure it at fair value on every reporting date, and change in fair value will be recognized in profit and loss. But now there is some complication. For that I have to sit. Okay. This standard setter they will not keep you life simple. They have written in case of financial liability measured at FVTPL, fair value gain and losses are recognized in P&L account. They should have put a full stop here, but they have written except that in the case of financial liabilities other than loan commitment or financial guarantee contracts that are designated at FVTPL, the gain or losses are required to be presented as follows. Okay, so for financial liabilities which are measured at fair value, you have to find out the reason for gain or loss. So they said you divide into 2 categories. Change in fair value due to credit risk. Change in fair value due to credit risk. And change in fair value due to other risks. This term credit risk is defined in IFRS 7 disclosure standard. Risk of default. Credit risk means risk of default. Risk that the one who is supposed to pay his obligation fails to pay his obligation. Is it right? Which can be you yourself also. Because if suppose you are Anil Ambani and you are not paying your liability, your credit risk has gone up. Credit risk has gone up. So it will change the fair value of that liability. You are suppose my friend Vijay Malya. Credit risk has gone so much that other risk has become zero. Now next line. Understood credit risk now? So the value of the instrument can change due to change in credit risk or due to change in other risk. Other risks are like market risk, interest rate risk. Okay. So the amount of change in fair value of financial liability that is attributable to change in credit risk of that liability, it's due to change in credit risk, should be presented in OCI. So it is an FVTPL instrument, but the change in fair value is due to credit risk, then that portion will be attributed to or transferred to OCI. Okay. Then the remainder of the change in the fair value of the liability will be shown in P&L account. So remainder will go to P&L account. As a student, you are not required to do this division. They will give you the numbers. Okay. But again, there is an exception. Exception, again exception. Unless the treatment of the effect of change in liabilities credit risk described above would create or enlarge an accounting mismatch in the profit and loss account, in which case all gains and losses will be recognized in P&L account. So I will repeat this last paragraph in simple term. If by showing credit risk in OCI, if there is an increase in accounting mismatch, then don't show credit risk in OCI, transfer that risk also to profit and loss account. If by showing it in OCI, it creates or enlarges an accounting mismatch, then in that case you can show the entire fair value change including credit risk in the profit and loss account. This paragraph is for theory, don't worry. Otherwise, if they ask you question, remember all these things. Fair value, normally P&L account. If it is attributable to change in credit risk, OCI. But if by showing in OCI it increases or creates an accounting mismatch, then again you show it in the P&L account. Then many times we give loan commitments or guarantees. These loan commitments and financial guarantees, guarantee you know, that is you commit that you are going to pay. You take yesterday in securitization we discussed, we will transfer you the loan, but I give you a guarantee of up to 10,000 rupees loss I am going to share with you. So that is financial guarantee contract. So this kind of contracts in the standards will be measured at FVTPL and change in fair value P&L account. What about reclassification of financial liability? Good news, not allowed. Only reclassification is allowed for financial asset. There also it is not allowed for designated instruments like equity instrument measured at FVT OCI or debt instrument designated at FVTPL. Is it right? There the reclassification is not allowed. Next is derecognition of financial liability. Derecognition means removal of the liability from the books. Okay. So it's simple. When you pay the creditor, what entry do you pass? Creditor account debit to bank. So technically what you have done? You have derecognized the creditor, the liability. Okay. So the standard says financial liability should be removed when and only when it is extinguished. Extinguished means discharged, cancelled, expired. Creditors are paid. Bills payable is paid. Loan is repaid. Debentures are repaid. Creditors are not paid. And entire amount is treated as discount. Cancelled. So sometime liability can be cancelled. I don't have to pay. I had a creditor but he has run away to UK and I don't have to now pay anything. So I will cancel the liability. Okay. In case of say derivative items, there is a due date or what we call contractual maturity date, expiry date, and suppose the contract goes unexpired. You have written a call option. You have written a call option or a put option. You received the premium. So you pass the entry bank account debit to derivative call option account, and till the option is settled, it appears in the balance sheet as a liability. On maturity date, the call lapses because the other party does not want to exercise. So I'll pass the entry derivative call option account debit to P&L account. Means liability has expired. Expired does not mean the person has expired. Even that is also a possibility for extinguishment. But here it means the contractual rights have expired now. Contractual obligations have come to an end. So what about the treatment of the difference between the amount paid for discharging the liability and the carrying amount of the liability? Here there is only one choice, P&L account. There is no concept of OCI in case of financial liability. So financial liability accounting is simple because it is either amortized cost or P&L account. And both items, whether it is amortized cost or P&L account, gain or loss will be recognized in P&L account whenever the liability is extinguished, means discharged, cancelled or expired. Oh, we have just come out of one and now entering into another. But before that, would you like to read the summary of provisions for financial liability or do it as homework? Homework? Okay, read now. Financial liability, FVTPL, subsequent measurement, fair value. Change in fair value that is attributable to change in credit risk is recognized in OCI. Remaining change in fair value is recognized in P&L account. On derecognition, amount recognized in OCI, when it will go to OCI only for the first line. If the change in fair value is due to credit risk, is not reclassified to P&L account. Underline. If there is a change in fair value due to credit risk, and if you have recognized in OCI, then on derecognition it is not reclassified to P&L account. It is transferred to another equity account. So that you have to take care, because it is also mentioned in IS1 presentation which item will be reclassified to P&L account and which item will not be reclassified. So this is an item which is not reclassified to P&L account. And in case of any other liability, amortized cost, interest revenue, credit impairment, foreign exchange gain loss will be recognized in P&L account, and on derecognition any gain or loss will be recognized in profit and loss account. Is it right? Now we'll come to derivative. I hope you have heard about derivatives. In financial management subject, normally it is taught. So what is derivative? General meaning of derivative. Then we'll come to the meaning given in the standard. General meaning of derivative means a derivative is a financial instrument which derives its value from another financial instrument or another underlying asset. That underlying asset can be a commodity or exchange, currency, then share, stock market index, election also, weather also. Okay, so like this. What is the objective of entering into a derivative contract? Three objectives are there. You can use it for hedging purpose. Which is the prime objective of derivative? Then speculation. But now this has become the prime objective. Sattebaji in Hindi. Is it right? That is, you are betting only on a upside or downside movement of price. Nothing wrong with that. Why do you think it is bad? It is okay. You have the risk taking ability. Are you not the risk taker? Are you not betting? The one who does such professional course which you are doing is the big time better. He is betting on himself. So what is the harm if I take some call option? And then there is a third purpose, that is arbitrage. Okay, arbitrage. That means you try to find there is a mismatch in the pricing and you try to take benefit, advantage of that, which involves less risk, less investment and generates a guaranteed amount of profit. Okay. This chapter does not distinguish what is your purpose. Okay. So whether you use it for hedging, speculation or arbitrage, will have same accounting. Derivatives are very great instruments which have been invented by people in the field of finance. It all depends on how you use it. Okay. So the standard says a derivative is a financial instrument or any other contract which have the following features. So in fact now they will give you some questions where they will ask you whether this contract is a derivative. Whether this contract is a derivative. They'll give you some features. So what you have to see, three conditions needs to be fulfilled. Three simple things you can identify in a contract. Its value changes in response to change in an underlying. Derivative always have an underlying. There cannot be only derivative because it derives its value from something else. So there has to be an underlying. And as the value of that underlying will change, the value of the derivative must change. For example, you have a forward contract on dollar. So as the dollar rate will go up or come down, the value of this forward contract will also change depending upon whether you are a buyer or a seller. If you have taken a option on foreign exchange, again when the rate of exchange changes, the value of your call or put option would change. Why derivatives are so popular? Because they require no initial net investment or they require smaller initial net investment. Then that would be required for an instrument with similar responses to changes in market factors. Now let us suppose you think that gold price is going to rise. Okay. You think that after 3 months gold price will rise and you want to benefit from your information. You want to benefit from your information. So what you will do? Buy 1 kg gold, okay? And you deposit in a bank locker. So how much it will cost you? Say 32 lakh rupees. Is it less or more? Approximately. And then after 3 months, the market value of gold is 34 lakhs. So your profit is 2 lakh. Yes or no? But for earning 2 lakh, how much you had to invest? 32 lakh. Can there be a simple way to earn the same amount of profit? You go to commodity exchange where gold futures are traded. Gold future is a derivative, but you have to pay some initial margin. If you want to participate in the derivative market, then you have to pay some initial margin on a future contract. It is like a deposit money to ensure that you honor your contract. Let us suppose the initial margin you pay is 3 lakh rupees. Initial margin is 3 lakh, and you have entered into a future contract to buy 1 kg gold at 32 lakh rupees. Same contract, but it is future now. No physical gold. So you save that warehousing charges also. Warehousing charge means your locker charges. You can't put in a warehouse, but storage charges. Storage cost you saved for 3 months. Then your money which was blocked, 30 lakh was blocked, 32 lakh, now only 3 lakh is blocked. So you saved a lot of interest. Okay, that calculation also we will see. Now tell me, if the price of the gold rises to 34 lakh, your contract price is 32 lakh, are you going to still make a profit of 2 lakh rupees? Yes. Difference between contract price and market price is your gain or loss. If the price rises, you are a buyer, you will earn. But see the difference between the two. Here I have to invest 32 lakh to earn a profit of 2 lakh. Here I have to invest 3 lakh to earn the same amount of profit of 2. So this justifies this line. Requires no initial net investment. Sometimes no initial net investment. For example, you go to a bank and you say, I want to enter into a forward contract with you. Okay, I want to sell $5,000 after 1 year. So they may sign a forward contract. They will charge some charges which is very negligible. Okay, very low. Or smaller initial net investment. Smaller, 3 lakh. Compared to what you have to invest to buy physical 1 kg gold to earn the same amount of profit. And that would be required for instrument with similar responses to changes in market factors. And the third feature of derivative is they are settled at a future date. They are settled at a future date, 3 months in this example. Immediately there is no point. How will you make profit or loss if you settle immediately? Is it right? So they let some time gap be there so that price will move. So that the price will change and then some gain and loss would arise. Example of derivative, long list is there. Some of them we will cover in this chapter for accounting purpose, forward, future. Then different types of futures are there: commodity future, currency future, index future, call and put option on commodity, currency indices, interest rate swap and currency swap. For the students doing CA course in CA final in SFM, there is a chapter on derivative where all these instruments are covered. Before starting any derivative accounting, first we'll discuss the feature of that instrument, basic understanding. So even if you have not studied, don't worry. Okay, understand the basic feature, then you will understand the accounting of it. So we are entering into a dangerous zone now where some prior knowledge of derivative will be an added advantage. Even if you don't have, don't worry. We will first discuss the feature. So first you have understood what is a derivative. It is a financial instrument whose value derives from other instrument. Now accounting. Prima facie all derivatives, whether financial asset or financial liability, is assumed to be held for trading. Is assumed to be held for trading. And therefore, they will be treated as FVTPL instrument. Because held for a trading instrument will be treated as FVTPL. But there is an exception. Unless they are designated and are effective hedging instrument, in that case, if the entity wants, then special rules of hedge accounting will apply, which I am going to take after this. Okay. And you get a lot of questions from derivative in the exam. So understand, derivative can be a FA or FL. Accounting, initially at fair value, subsequently at fair value, change in fair value, P&L account. However, if the derivative is qualifying as hedge instrument for hedge accounting, then follow the treatment suggested under hedge accounting rules. For the beginners in derivative, one small example, forward contract. It's a very basic derivative contract. What is a forward contract? Two persons, okay, A and B, they can just sit across the table and they can enter into this contract. A says, I want to buy one government bond from you, not band, sorry, bond, one government bond at rupees 10 lakh, okay, after 3 months. So what B is saying, I will sell you one government bond at 10 lakhs after 3 months. So after reading this example, understand the meaning of forward contract. A forward contract is a contract to buy or sell. A forward contract is a contract to buy or sell a specified quantity, which is 1 unit of government bond, at a specified price, which is rupees 10 lakh, on a specified date. Specified quantity, specified underlying, specified price at a specified date. So they locked the rate in advance for this government bond 10 lakh. Is it right? Such contracts are called forward contracts. Forward contracts. Rate is fixed in advance. The execution or the delivery will take place at a future date. So such contracts are forward contract. This is an example on government bond. It can be for anything. It can be for a laddu also. You can go to some sweet shop and say, I want to buy 1 kg laddu after 3 months. How much will you charge? Fix the price. After 3 months, go pay the price, come back. Okay. Of course, they will not do such transaction unless it's a huge quantity. Then you can enter into forward contract basically for foreign exchange with the bankers if you're exporter or importers. So that time they use forward contract quite a lot. See this example, same example now. This person, purchaser, will deliver 10 lakh rupees and receive one government bond. When will this contract become a financial asset for him? When the market price is more than 10 lakh rupees, because he has a right to buy at 10 lakh. Suppose market price is 12 lakh rupees. He is in a potentially favorable condition now, because he will pay 10 lakh fixed amount. He will get a bond whose market value is 12 lakh. When will this instrument becomes a liability for him? Market price is below 10 lakh, because he still has to pay 10 lakh to buy something whose value is below 10 lakh. So the contract has become unfavorable. Here it is favorable. Opposite happens for the seller of the forward contract. Seller under forward contract. What Mr. B has committed? I will sell you one bond at 10 lakh. I promise to deliver one bond at 10 lakh after 3 months. After 3 months. First I'll come here. Bond price have gone above rupees 10 lakh. These two should match. So now bond price have gone above rupees 10 lakh. So will he cry or will he be happy? Cry. Because he has to still deliver at 10 lakh. But the market value of that bond is 11 lakh. So the contract has become unfavorable for him. But if the market price falls below rupees 10 lakh, contract has become favorable. He will deliver at 10 lakh only. Okay, he will deliver at 10 lakh only, even if the market price is 9 lakh. So this is called forward contract. Some question on forward contract will come, so keep this feature in mind. Forward contract is a right and obligation. Forward contract is a right and obligation. Right and obligation means you can demand the performance, you have to perform also if other party wants it. So you have a right and obligation. Second thing about forward contract, there is an unlimited risk, unlimited gain potential. Unlimited risk and unlimited gain potential, because the price can go to any extent, gain or loss can be very high or very low. Both parties are exposed to the risk. Both parties are exposed to the risk, and both parties are also, of course, exposed to the gain. Okay, these are forward contracts. They are negotiated over the counter. They are negotiated over the counter. That means the two parties can just come in contact with each other directly, and they can negotiate the terms and condition. Which underlying we have to buy or sell, when we have to buy or sell, at what price we have to buy or sell, in which quantity I have to buy or sell. You can negotiate on each and every terms of the contract. These are called forward contract. But in forward contract there is a problem, counterparty default risk. After suppose 3 months, the bond value goes to 12 lakh rupees. So A will go to B, Mr. B, hello, give me one bond, take your 10 lakh rupees. B is not available at his home only. Okay, message was on the answering machine actually, not available. Okay, again you call, phone is dead now. Then you search him, is not available. Go to court, go to police. Court will say, already we have 3 crore cases pending and nalak, you have also come and added one more case. Right now we are dealing with all high profile cases. Anil ji is in the court, Malya ji is in the court, Salman Khan also comes frequently, Salman Khan, Sanjay Dutt, and we will deal with these cases. Or so to avoid that counterparty risk, what people in finance world have designed, future contract. Okay, because the risk was there in that forward contract. So if you don't want to take that counterparty risk, you deal through exchange. Same instrument, basic features are same, unlimited risk, unlimited profit. Okay, it's a right and obligation, but the advantage of future is you have to deal through an exchange. A and B now will not meet directly with each other. They don't know who is the party at the other end. A has to deal with exchange, B has to deal with exchange. So exchange says, come to me, I will ensure that I will honor your contract. How will the exchange ensure that the contracts will be honored? Then they take initial margin money from both the parties. So both the parties are required to deposit some percentage of the value of the contract, which we will call initial margin. Which we will call initial margin. It is like a deposit money. In the FR paper, in this subject, you are not required to calculate that initial margin. That you will learn in the strategic financial management subject. Okay, here it is given. Only we have to do the accounting. When we make the investment in initial margin to bank. Sometimes they may ask us to bring more initial margin. If the exchange thinks no, risk has increased, bring more initial margin. You have to bring more initial margin. One more entry, initial margin to bank. And they also ask you to pay on a daily basis something called mark to market margin, which is the difference between daily closing price. So it means on a daily basis the exchange is collecting the difference from you or paying the difference from you. So the risk is very less. and on they have also initial margin in their account. So the risk is very negligible in the case of future contract. Okay, not only exchange is there, there are brokers also on both the ends. So exchange will not again catch hold of the person directly. First they will catch hold of the broker, and broker will then recover money from his client, right? So this is future contract. It is a contract to buy or sell a specified quantity at a specified price on a specified future date. Index future are very popular, like Nifty index future. Daily volume of trading in this Nifty index future goes into thousands of crores of rupees. Do you know that? It is more than the share market value in terms of volume. Then equity share futures are very popular. Like for example, Reliance Industries future. To buy a share of Reliance, you have to pay 1000 rupees. But to enter into future contract, you may require say 100 rupees, 150 rupees. But the profit will be same after 3 months, whether you buy the share or you buy the future. So futures are getting popular. And then the most popular future in India is commodity future, where people buy in huge numbers. Okay, ordinary people also, they buy futures. Now the remaining chapter in future tomorrow.